Hey everyone, this is Roshan Basnet, broker with Real. Today I'm excited to talk to you about the changes that are happening in the mortgage side of the world and also real estate context. Obviously, in Canada, we've since April we've had three consecutive quarter point rate drops. There are signals of more to come. The latest inflation numbers are 2%, and also in the south of the border, the Fed cut, 0.5%. They have signals of cutting further 0.5% four consecutive times in 2025 and 26. Inflation there came out around 2.5%. Ming Wong is here with me. He will give you a quick introduction of himself, and he's really the expert on the mortgage side of the world. He can also give us some insights of what is happening right now in terms of the mortgage application. And we want to talk to you also about changes in some of the CMHC announcements for first-time home buyers and things of that nature. So with that, Ming, welcome and thank you so much for your time so that we can inform the consumers and consumer can have better information. So if you can give us a very quick intro, that'll be great.
Yeah, okay. Well, good afternoon, Roshan. Thank you for inviting me here. My name is Ming Wong, and we provide consultative services for people like yourself who are looking for homes. We basically work with you from the beginning right till the end. That means that when you come to us in the beginning, we do a full pre-qualification, which means that we actually look at your income, your down payment, your liabilities, and we not only just talk to you about it, we actually ask you for an application and a documentation. And that's important because in today's market, you want to make sure that when you go out and purchase a home, you have 5 days conditional financing and you want to be comfortable that you meet the conditional financing. You don't want to waste a lot of time looking for a home and find out that you don't qualify. So it's important that you do the homework up front because at that time of buying a home, it's very important because there's a lot of emotions involved and you don't want to lose that home.
Yeah.
So Roshan, I just want to just add to your notes there with regards to the basis points decrease in interest rates, which is very good. Now, we've seen the interest rate go up substantially over the last year. It's gone up substantially to a very high rate. And what's happening is that the Bank of Canada is seeing that, yes, inflation has come down, but the real thing is that the economy is hurting.
Oh, yeah.
We've seen some unemployment going up to about 6.7%, 6.8%. So what the Bank of Canada has said from the beginning was the following. Yes, we know that the Canadian economy will be hurt with the interest rate increases, but we can always stimulate it by decreasing the rates. And this is the time for them to stimulate the rates. In fact, we thought they would have stimulated it much earlier because we've hit already 2% at this point in time, right? So we're seeing that the interest rates are the inflation numbers are coming down. We're hitting the target. And one of the things that you should note is the following, is the mortgage interest rate is actually part of the inflation number. So the higher the interest rates go, the higher inflation goes. So it actually has an inverse effect there, right? So, I think the last time we looked at it was about 1.3%. I think maybe now it's about 0.8%. So really, if you take away the interest rate component of it, we're way below the 2% that you're talking about. So that's very good news. Now it's a time for us to take a look at how we can build the economy back up, to bring it back up to where it's supposed to be way back in 2022, 2021, that sort of thing, right? So that's what they're doing. And, we do definitely have some exciting news with regards to some of the new CMHC guidelines, which was actually announced recently.
Looks like it's going to be perhaps a busy fall or an early spring market from the sounds of where things are, because things are pretty much there's still pent-up demand. There's still buying and selling had pretty much stopped. So this might increase. When I look at my local market, which is Oakville and Burlington, surprisingly, there are 37 detached properties right now, as we speak, for under $1 million. We never saw this. There used to be, 5 or 6 or 7, but I was very surprised to see 37. And perhaps investor groups are the ones that probably need to really rally up if they want to grab them, because with the noise of positive signals, rates and things of that nature, market might pick up. Regarding rates, obviously these rate cuts are tied to the prime mortgages. What about the fixed side?
So really, when we have the Bank of Canada rate, that's really the everyday rate. This is the rate that the banks borrow money against, right? So really, that's what's happening with the Bank of Canada rate. We've seen the decrease, and we also have what we call the bonds, the bond yields that comes out with them, and that's really your fixed rate. That's dependent on the Bank of Canada. That's depending on the economy. That's depending on the what's happening around the world and things like that. When they feel it's very positive, the bond rates come down a little bit, and which makes the fixed rate comes down a little bit. So it's very good. We're seeing that the Bank of Canada has decreased the rates. The market is seeing it very positive, and we see those positive decreases in interest rates in the last little while. Okay, so let me just give you an example. Today, I have a 3-year term promotional offer, okay, 60-day close for 4.39%. Okay, 4.39%. We've expected the interest rate to be, in the next year or two, to be anywhere between the high threes and the low fours. We're pretty close to that already. Okay, so there's a lot of competition now for customers to come in. So the fixed rate is getting pretty competitive now. 4.39 for some of you might not think it's cheap because you've seen 2%, you've seen 1.99. Well, take a look at it. Probably about 9 months to 10 months ago, the same product is probably at about 5.1959. So substantial differences in terms of decrease in rates. The Bank of Canada has decreased it by 75. The fixed rate has actually decreased by more than 1%. So we're seeing a very positive, we're seeing a very positive decrease in rates, so which is and it's starting to get people to start thinking about buying homes again. It's whether they are going to start buying or not, but definitely with the new changes in the program, it'll start bringing people back into the market. Basically, there's a lot of incentive for people that are looking at buying.
Yeah. While you are here, because you are expert on this, why are insured mortgage rates cheaper than putting the 20% down payment?
Yeah. Okay. So it seems kind of illogical, right? I'm putting less down payment and I'm paying a lower rate, whereas if I put a higher down payment, I'm paying a higher rate. There should be less risk associated with people putting down payments, right? The reason for that is very simple. People that are putting less than 20% down, which is insured, they have to pay a CMHC premium on top of that, right? So you have to say, okay, well, I have a discounted rate. I have to pay a CMHC premium, which can go up to 4% of the mortgage amount, okay? So think of that mortgage that you've taken, $500,000 or $1 million mortgage. Now the bank takes that and goes to the market and raises funds. Okay. That $1 million mortgage that they go into the market to raise funds for it is secured by Canada.
I see.
They will not lose money on that.
Yes.
So because it's more secure, they can borrow it at a lower rate. Whereas on the 20% or more, the interest rate is higher because when they go to the Bank of Canada, it's not secured by the government. It's only secured by the bank. So therefore, when they raise it, the interest rate is a little higher. And that's the difference between it.
Yeah, because someone will argue that, hey, I'm putting 20% down. Could be $300,000. I should get a better rate than somebody's putting 50,000. And it's good to know because of the risk. That's what's causing it.
I get that all the time. And I have to explain to them. It's just weird, when you have to explain to them all these little things associated with it.
Okay. Absolutely. Okay, now talking about this big announcement from CMHC a couple of days ago, especially for the first-time home buyers, can you give us a little bit more in-depth insights to that?
Okay. Yes. So really good announcement. I think we're hitting an election fairly soon. With all the announcement. Originally, what the government did was they increased the amortization from 25 to 30 years for new home builds. Okay, starting August of this year, they were able to do that. For new home builds, less than 20% down. So what does that mean? It means that your mortgage payment is less. Okay, when you go from 25 to 30 years, your mortgage payment is about 9% less, which means that you qualify for a bigger mortgage amount if you want. Okay, so you can look at it either way. I'm either paying less money or I can get a bigger house. Either way, you can look at it either way. So that's the key part of it, right? Now, beginning December 15th, they've expanded this to all homes, not just newly built homes, okay? And they've also increased the amount from $1 million, which is the maximum for underinsured, to $1.5 million. They're taking into account the geographic area, Toronto and Vancouver, Victoria, where the home prices are much higher than $1 million. I was a little surprised at the 1.5 nationally across Canada because obviously, 1.5 million in Halifax, quite a big house, whereas 1.5 in Ontario and Toronto is really, an average house. I mean, it's not bad, but it's still not, probably a monster home out in Halifax.
For sure.
So that's one part. The second part is that, the amortization for all these will be a 30-year amortization, as I said before. It'll be 9% lower with regards to any payment. So you can qualify a little bit more. Now, the down payment, they have not finalized yet in terms of the minimum down payment. So if I use today's criteria, okay, where the first 500,000, you have to put 5%. Anything above that, you have to put 10%. So if you go up to 1.5 million, you would put in $125,000 down payment. That would be your minimum. Okay. Now this is going to be finalized. It's going to be around that, maybe 125, 150, whatever it is. But think of it this way. Today, if you're buying a house for $1.5 million, you need 20% down. You need $300,000.
Yes.
That's a big difference on that, right? So there's a big amount that's very different with regards to now. This is only available the first time. If you're an investor, the answer is no. If you bought a house before, the answer is no. That's the way it works.
Now, if the applicants are split, in other words, if one of the applicants, husband, wife, had already purchased before, they are not truly, both have to be first-time home buyers?
Yeah, that's a good question, Roshan. I mean, we're still working with the final details right now.
I see.
But in a general rule, right? Generally what they do is if one person is a first-time home buyer, basically they qualify.
Got it.
Okay. However, there's got to be some logic behind some of this thing. Something's got to make sense. Generally, they're going to look at the primary applicant, the one that's making more money. Are they the one the first time home buyer, right? So if that's the case, this policy will apply. You can't have someone where they're looking at a $1.5 million. This is their third home that they're buying, and they're adding their son to it who's making no money, but he's a first-time home buyer. You're going to say, no, this program, in the spirit of this program, you don't qualify. There's going to be some logic. We're not saying black and white. When you bring in the scenario to us, we will review with the lenders, and there may be a couple of lenders that will say no, but there may be a couple other lenders who will say, yes, this is okay. We can accept this risk. We understand what it is, right? But it can't be someone making $10,000, another person making $150,000. It's very hard for me to rationalize and provide that to our lender.
Makes sense.
The whole idea initially when they were focusing on new build was to see if they can stimulate the construction industry too, right? They want to stimulate the construction because it's slowed down a lot.
Yeah.
So they're trying to stimulate that, but now they've expanded to everything. So whether it's a new build or whether it's whatever, I mean, you can put much less down payment. That's very positive news. And I think in the new construction, you may need less down payment going forward, right? Deposits going forward, right? Because the down payment is lower, right? Too.
Yeah.
So
I guess once things irons out and how much that down payment threshold is, which is 5% plus 10% for in between gap, whatever is today. If they hold that true, then if somebody were to really buy a $1.5 million home, that CMHC insurance is going to be heavy though. Because how much is it today? Like
on the top end, it's about 4%. So on $1 million is going to be $40,000, right?
Yeah.
But you have to think about it the following. It sounds like a lot of money, but you amortize this payment over 30 years.
Okay, so you're putting back into the mortgage and re-amortizing that.
Yeah, that's what it is. Yeah. So sometimes the mortgage comes out to almost about the same thing, the down payment, right? So on a 5% down right now, if you put a 5% down, you probably find that if you put $25,000, your insurance is $20,000.
Yeah.
So it's that's how it is. So it adds back. You got to remember the following, right? Now you need less down payment, eh?
Yes.
You need less down payment, so that helps a lot. Okay. I would say that on the insurance premium, don't get too fussed on it. If you have the money, go ahead, pay for it. Don't get it for the sake of getting the insurance, right? But if you don't have the money, this is the time for you to get into the market and get approved, right? So that's all. It's all positive.
Yeah, and get a better house too.
Yeah.
And be able to, instead of being short-sighted and saying, okay, I'm going to be here for 5 years, you could actually secure a better property that you can be there for a longer time.
Sure.
I have another question here is those 37 detached homes that I was talking about under $1 million. In today's standard, they are nowhere near where they are. They're built in the 60s and the 70s, and could be even original owner, could still have 1960s brass light fixtures. Now, if somebody were to buy that, I mean, I know there's purchase plus improvement scenario. Do you see any way that this could open up that door for, let's say somebody buys it for 1.2, truly first time home buyers, and they want to improve, whether it's 20% up or whatever the value, and they can stretch it to 1.4 or 1.5. Is that possible?
Yeah, so on the purchase for improvement actually is one of the programs that is underutilized. Okay, people talk about it, but they don't really do it. It is actually a very good program. The key part about this one here is a lot of banks generally go up to about 10%, Yeah, so it's not going to be like, and the reason for that is they want you to finish it within 3 month period. When you have like large construction, 300,000, it's going to take more than 3 months to do it. So they want to see this is where it is. So you can put a fence, you can upgrade the windows, you can do the shingles, things like that. So it's nice and quick, get it up. But some of them you can even fix a kitchen up, or like change the cabinets or change the washroom, whatever it is. So generally it's going to be about 10% about the maximum they will do. And I think it's a very good program advantage. So if you bought a house for $1 million and you think it's going to take you 100,000 to fix it up, take advantage of this program. As long as the price that gets appraised at the end will bring you to the value of $1.1 million. Okay. If it's for small things, like I've seen, I've done customers where all they did was they put a fence up and they charge them $10,000. That's not a problem. They just put down the $10,000 and they'll move ahead. They won't even do an appraisal on it. But this is for substantial changes into the house.
Yeah.
Okay?
I mean, I experience that all the time because, especially south of QEW, these older neighborhoods. I mean, there are homes that comes up all the time. These are bungalows, raised ranch bungalows, split level homes, and they are really nice. Nice neighborhood, nice lot, mature area. But if somebody's really stretched out and they really don't have the cash flow to make any improvements, then it becomes a turnoff, and they could move into the better townhome situation. If purchase plus improvement actually, if someone were to take advantage, can really secure really good properties here. And if this extends to first-time home buyers with a 30-year amortization and perhaps, the spread that's going from over $1 million, I think it'll be a win-win. I mean, I will encourage those type of buyers to come look at these properties more than going into townhome situation.
I agree. And I think that people that are sitting on the sideline, it's probably time for them to come back into the market, because with all these changes to the market, we're seeing that, people are still thinking, maybe I'm going to wait for the next rate decrease,
Yeah.
right? I know there's going to be another rate decrease, right? But the reality is that when rates come down, home prices likely can be going up.
Yeah.
So, what do you want to do? Pay a lower rate, or you want to do 20 offers in there, see if you're going to get the offer and pay a higher price for it. So I think this is a good time for people to look at buying houses. And we're seeing a lot of customers doing that. They're saying, hey, well, how much do you get pre-approved for? And then they're starting to start looking for the houses right now, because it's still calm. But with the changes that are coming up, we expect the market to be much stronger.
Yeah, absolutely. I mean, if somebody wants to jump right away, they better go through true full evaluation. So what is that called? Is that pre-approval?
Yeah, we call it a pre-qualification.
Yeah.
And then we'll do the pre-approval right after that.
I see.
So what the pre-qualification is more taking a look at their phone, talking to them on their phone and saying, hey, by the way, you qualify for $1 million home, and here's the down payment. Now, for us to assess that in a little bit more detail to make sure that it meets the bank standards, we'd like you to complete an application and provide us with the documentation to support it.
Yeah. And I think that's what some of the buyers that are sitting on the sideline needs to prepare and get ready. Because if the floodgates opens up and the market, it's the smell of, homes are selling, and that's just going to be crazy. None of these 37 detached homes under 1 million are going to be there on the market anymore. So, good point is get ready, get pre-approved, ready to go. And if you find the right property, obviously, go for it.
Yeah, I agree.
Okay, I think this is a really great conversation. Ming, thank you so much for your time. I hope to do more of this, and then you can appraise us more about what is happening on the mortgage landscape, because how many new applications came through, how many are actually converting, and that'll be good information for someone who's looking to enter the market to know that it's not too late, because it has too late has happened multiple times to some people. Let's avoid that.
Yes. Yeah, agree. And thank you very much, Roshan, for inviting me to this session.
Okay, we'll talk again.